Stagflation means that high inflation and stagnant growth occur simultaneously in an economy. Under normal conditions, when inflation rises, demand is strong and accompanied by growth. However, in the year 2026, the world economy has moved outside of this classic cycle. While price increases, inflation, have become permanent in many regions, economic growth has weakened significantly, falling below forecasts. This situation, which international organizations described as a risk starting from the last quarter of 2025, has turned into a concrete stagflation reality. For many developed and emerging economies as of the first quarter of 2026. If you liked the video, don't forget to like it and subscribe for more videos like this. There are several critical factors pushing the global economy into stagflation. The first of these is the structural inflation experienced worldwide. The disruption of supply chains after the pandemic, raw material prices remaining high for a long time, and the increase in logistics costs caused inflation to become permanent. Central banks, thinking that inflation was temporary, did not intervene sufficiently at first. Later, interest rates were raised, but this move cooled the economy and suppressed growth. The second important factor is energy prices. The global energy market has been in serious instability for the last 4 years. The energy shock that began with the Russia-Ukraine war was re-triggered by increasing tensions in the Middle East. Europe has become the most vulnerable region, especially due to its dependence on natural gas prices. When energy prices rise, both production costs increase, and the purchasing power of the consumer decreases. This situation both pushes inflation up and slows down growth. Thus, the exact definition of stagflation is realized. The third factor is the level of global indebtedness. Governments around the world borrowed massively to keep the economy afloat during the pandemic. Even in developed countries, the debt-to-GDP ratio reached historic peaks. However, when interest rates rose, borrowing costs also increased. Today, many countries have to allocate a significant portion of their budgets to debt interest. This reduces the investments needed for growth. While debt pressure lowers growth, interest expenses expand budget deficits, and inflationary pressure continues to increase. The fourth factor is the intensification of trade wars and geopolitical tensions. The trade war that started between the U.S. and China has now turned into a permanent conflict, shaping the global economy. Technology restrictions, customs duties, export bans, and competition in strategic sectors between the two countries are disrupting the flow of world trade. Frequent disruptions in supply chains increase costs and create inflation. At the same time, growth is weakening because it reduces global trade volume. This atmosphere has become another factor, increasing the risk of stagflation even further. The fifth factor is the decline in global consumer confidence. In many countries, the purchasing power of the people is eroding due to inflation. Even if wages increase, a real loss of income occurs because prices rise faster. As consumers hesitate to spend, demand weakens and businesses produce less. As production falls, growth is suppressed. However, prices do not fall because costs are still high. Thus, while inflation remains high, growth slows down even further. When all these factors combine, a picture emerges where uncertainty, slowdown, and persistent inflation are intertwined. Many economists compare this picture to the period of stagflation experienced in the 1970s. At that time, oil prices rose rapidly. The world economy could not withstand the shock. And while many countries experienced a long recession, prices continued to increase constantly. Today's energy and supply chain conditions show that a similar risk is at the door. The effects of global stagflation can be multi-layered. First of all, countries may need more stimulus packages to achieve growth. However, since inflation is high, these incentives will be risky. This situation condemns central banks to a difficult balance. If you increase interest rates, you kill growth. If you lower them, inflation climbs. In other words, an arena with no exit is created for policymakers. The second effect is seen on companies. While cost pressure increases, demand falls and profit margins are squeezed. While some sectors are forced to shrink, others have to stop completely and restructure. The fact that even big technology companies have gone through successive layoffs in recent years is actually a sign of this pressure. The weakening of global growth leads companies to act more cautiously regarding the future. The third effect is seen in financial markets. During stagflation periods, stock markets follow a volatile and suppressed course. Because both growth expectations are low and interest rates are high, investors do not want to take risks. In this case, the search for a safe haven increases. Gold, bonds, and some commodities come to the fore. However, high interest rates can make even the bond market risky. For this reason, global capital takes on an indecisive structure, constantly searching for a place. Perhaps the most visible effect of stagflation appears in the lives of ordinary citizens. They have to buy everything from food to energy, from rent to transportation at higher prices. However, since their earnings do not increase at the same rate, their living standards drop. This situation triggers social unrest and increases political pressures. This is also the reason why the economy is the determinant in elections in many countries. Economic insecurity can lead to the acceleration of political changes. According to International 7 period, is critical in terms of stagflation. Reports from the IMF, OECD, and World Bank state that global growth will fall, but inflation will not easily retreat. In other words, the world is stuck in the dilemma of a cooling economy heating prices. As long as this dilemma continues, the risk of stagflation will constantly increase. As a result, today's economy is going through a period where both supply and demand side problems intersect. Energy supply is uncertain, the supply chain is fragile, the debt burden is increasing, geopolitical risks are multiplying, and central banks are losing their room for maneuver. This combination creates all the necessary conditions for stagflation to emerge. Of course, it may be early to talk about a definitive crisis. However, current data clearly shows that the global economy is moving towards a period of serious slowdown and persistent inflation.